Recording.
All right.
Okay, and where is my chart? Okay, here is my chart. Okay, nice. So let's start. So today's main topic is market context. So what is market context overall? Okay. Okay, so these weird sounds are my dog. Is my dog again drinking water? I don't remember if he was drinking water during first session.
He did. He did.
Yeah, he did. Okay, okay.
No problem with this.
Yeah, but I think you will hear me clearly.
Yeah.
So, what is market context overall? First of all, for me, it's like a language. So you can think about it like a language. So uh, sometimes we can't understand everything what the market wants to tell us. Yeah, because what we see here is just a visual representation of a price. So what these candles and everything is telling us is that, okay, this moment the price is this number, and this is what happened before. It shows us some patterns, it shows us some models, but now, of course, we need to know what we kind of need to know what will happen. And this market context is a set of tools. Again, it's not rules, but it's kind of like the words, the sentences that the market can use to communicate what the market wants to do with the price next. So the easiest, of course, what we discussed before was the easiest form of market context. So for example, if we see that the market is moving up, comes back into the zone, then our expectation is that the market overall wants to go and clear this high. And by the way, I will send you Outlook examples where we with students discussed this place in the market, or maybe here, and we discuss why these structural zones have less chances to hold, and why this overall bullishness should continue to the upside. Again, it's not like it's not like we just want or just consider this option, but with the more probability.
Yeah. Okay.
And this is like the simplest form, just this, some kind of a structure, some breaks, some zones, and so on. Then you can add another layer, is the quality. Yeah, so you can say, okay, my break is there, but the quality can be like a really clear break, confident break, or it can look more like a liquidity grab. So this is something that you already saw in the videos and already tried to apply. And so and there are other things that we can use and that we will discuss today, that you can use while analyzing and while executing on the trades. So actually, again, all these models of price behavior, of price action, for me, they are like words, like sentences, and like phrases where the market is trying to say us, okay, here I am. So I was moving bullish. I am now building these highs just in the same place almost, or already above this high. So at this point, when we look at the market and we had this prior break, already mitigation of a zone, yeah, so what the market wants to do right now, is there more probability that it will go lower now, which it can do, but based on everything, on these clear breaks, on these clear zones, and so on lower time frames, most probably the market will just continue moving up. Yeah, so this is like really
Yeah.
simplified explanation of how you can use something like context. And again, why it's important to understand that we are not only trading the patterns of breaks of structure zones, we are actually trading context, because what is the overall problem for many people? They expect their expectation is that they will just learn some patterns, and like they will be the same like every time, or almost basically saying, but the market will present itself a bit differently each time, and you need more depth to your rule, and like a bit like a wide set of your instruments, how can you read the price? And how, of course, there is a lot of like mechanical part, and that's why we actually have a checklist for the context where we can say, okay, this is like more bullish or this is more bearish. But yeah, you need to build your own experience and understand it. So let's start actually discussing it. So context will be divided on analysis context and then execution. I will go through these points one by one in short, but I want to emphasize that you will continue to study context while you will be doing your homework, which will be testing and which will be learning new videos that I will send you, which will actually include like real life examples of trades, outlook examples, and so on and so on. You will send me market outlooks for some pairs. I will comment on it. So this is not, again, this is like a wide topic, okay? It's not something that I will tell you now. It will require you to come back to this, maybe to this recording or to some of the videos. It will require you to show the effort of learning and trying to understand. Because again, if you're just looking, basically you can trade just confluence of structure. So you can just wait for the time of the market when it will be just bullish on weekly, bullish on daily, bullish on lower time frames. You will wait for your zones. But the problem is, and the question is, if you are ready to actually wait for a lot of confluences and for the most obvious context of the market. I mean, it's possible, but when you have better understanding of what is happening overall and what the price can do, you can, for instance, remember you said like sometimes the price just goes without tapping into a zone. Yes, so you have a zone and price just does not tap. But what the price will do here on lower time frames? Most likely it will do this. So it will not tap into a zone, but maybe you missed some kind of a tap for a bigger zone, let's say. So let's just pretend. And then you have these shifts on lower time frames here, and you understand that your overall target from this range would be this high. And so even if the tap was not there, but maybe the tap was to some bigger zone, you can now follow this price action on lower time frames, or something like that. So when you have a good understanding of context, you can have more possibilities for executing your trades. And first point in analysis context will be our classical multi-time frame analysis. Every time you are performing an outlook for any instrument, for any pair, you need to actually start with multi-time frame analysis. But now you don't want to actually just say, okay, my weekly is moving like up, my daily is moving down, my 4 hours are moving up, and so on. You need to try to make a relation between these multi-time frame structures and zone, and what and how the market did before. So what I mean by that is, when you are looking at the market, you can, so if you are using like really simplified approach, you can tell me this. Okay, Dima, you can say we are in this bullish impulse on the daily, and so we are bullish. Now I want to trade only longs, for example. And yes, you are technically right. We are in this bullish range, and maybe you could have some trades from there. But now you need to ask yourself, what happened before? And the easiest example would be this. Is this bullishness coming from the previous bullish market or from previous bearish market? Because if you see, for example, a bearish market that made one bullish shift, so this is a bullish shift, and now compare this to a market that was previously bullish, maybe shifted back bearish, and now shifted bullish again. So this bullishness is not the same like this. So this bullishness is actually an indication of a bearish market, because this is a redistribution pattern, redistribution model that we will discuss a bit today, and that you will learn later in the videos. So you need to try to build connections between multi-time frame and actually tell to yourself. So if you will record a video, which will be a part of homework, you will need to trace the price and try to understand how the market moved before and what it did before. So for instance, for this kind of bullishness, you can go all the way here and try to understand how this trend changed here, how the market became bullish, how it went for some local reaccumulations, became bullish again, created these higher time frame impulses, higher time frame zones, started to mitigate it, and continued to be bullish. Yeah, and now our expectation is, of course, most likely more bullishness for Euro USD. But if you are just looking at this one specific break and that's all, then your picture will be not complete. So you need
that means I would be missing the whole story.
Yeah, of course.
The price is telling.
Yeah, definitely. You need to have a wider view on the. So you need to take into consideration what happened before, and again, the more we go, the more details I will show you. Now, so this is multi-time frame, but a bit with a deeper understanding. Now, the quality of structures and the quality of counter structures and zones. So let me explain what it means. First part you already know. So when you performed your multi-time frame analysis, now it's time to double check with the quality of your current structures, with the quality of your current ranges that you are working on. So for instance, if my entry time frame is 1 hour, then daily time frame is basically like my nearby structural time frame that I can build bias from. And then I will need to find some confirmations inside. However, again, I need to look to double check with my quality of my breaks, of my zones, and just decide. So for instance, if this zone is like was much lower in quality, I can decide that I will spend only 2 losers or 3 losers max in this zone or something like that. Or maybe if the zone is bad, then I want to have my lower time frames to perform some build up of bullish price action. So on lower time frames here. So I will not go directly from a lower from a lower quality zone. I will want more confirmations that the price actually wants to reach this high, for example. And also, so this is something familiar to you, but then you need to take into consideration the quality of counter trend. Again, I'm saying counter trend, but actually it's against your bias. So for instance, if you were someone that was looking at price at this moment, you will see that you had these structural shifts from daily. So actually, at this point, you were looking at bearish market. Basically, you had 2 bearish shifts of structure, and if you are just looking simply simplified on the market structure, you could tell me you could tell me something like this: we have 2 shifts to the bearish side, and now it's a bearish market. But if you are someone that is using context, you can say, but we have this higher time frame bullish impulse here, and now we are mitigating it. And now, what about the quality of my counter structures? And as you can see, the quality of them is really poor. So this impulse, the impulse is quite okay, but the zones that this impulse is coming from, they are all mitigated, they are all weak, so there is no clear zone here. And now the market came to these zones. So what is the reason now for the market to be here? If everything was mitigated here, basically the market should break here to the bearish side if the intention was this. But now the market didn't do it. It broke some internal structure, and now it started to confirm this higher time frame bias. the quality of these structures that are playing against us, because of course at every moment the market will be influenced by bullish powers, so to say, and bearish powers. But we just need to try to understand what probabilities are playing to some side. And again, at this point of time, the market started to confirm its bullishness. So this is an example of how can you try to read what is playing against you. Okay, so let me close this podcast. Now, so this is the quality and counter structures and so on. And the continuation will be price action against your main bias for more complete picture. So I will not stay too much time here, but just don't be fixed on one bias. Always remember that something is playing against you. Even in the most clear bias, try to ask yourself, okay, but maybe if I was bearish in this situation, what could tell me about bearishness? So let's say this situation. Yes, I'm here really bullish on Euro USD, but what can play against me? So in this case, I can go to monthly and see that I am in this big impulse from monthly. So actually I'm technically in a bearish impulse, in a bearish range from monthly. And so this is one. Then second, we are kind of starting to break the high, and in this situation the market it can do something like this. So it can just print a huge candle and take everyone out and so on, but it also can do something like this: grab some liquidity and go a bit to the downside to build more structure there and break later. So it can do it. Or it can just grab liquidity and start a deeper mitigation. So it can do different things, and I don't want to forget about it. But then you need to ask yourself, out of different situations, what is happening right now? And for example, for my bearishness, I don't have anything on daily. I basically don't have anything on 4 hours. So if I want to see this market to go to the bearish side and even to trade bearishness, then it would be really nice to wait at least for this break on 4 hours, and even then it will be pretty bullish. But if you want to be bearish, basically you don't have anything except this inside structure. And so you see what I'm trying to tell here, that yes, this market now is really bullish, but if my idea is that it wants to go bearish, now I need to have now I need to plan ahead and paint a picture in my head what will happen what should happen in order to this market to switch to the bear side. And if this market will go down, it will first, for example, break this. It will be at least more confirmation for the bearishness and so on. Now this next point is really important. This point we will discuss reaccumulation and redistribution patterns, and of course their clarity in relation to multi-time frame and so on. So can you remind me if you studied Wyckoff or anything about accumulation, distributions, and so on?
I had a look at Wyckoff once, but I stopped it because it was very, very complicated.
Okay.
Marking out all the stuff. I saw a video about why you don't need Wyckoff. This was more like me.
So actually, we will not do any markups here. We will not do anything like that. But what we will do is to use some part of his teachings. And what he was actually teaching and studying is that this general theory is that the market, before making some moves up, it undergoes some accumulation, So it can be in the form of like a big box or just a form of liquidations of some lows or anything like that. Then some build up starts, and then you have some markup stage.
Yeah.
And so why this is important?
And as far as I understood from these Wyckoff videos or from this, you have exactly the same kind of pattern in this area where price wants to go up. So you have exactly like this accumulation, and then you have that.
Yeah. So our strategy is actually is coming from the Wyckoff, but we just don't need and don't want to mark it all. We just need to know that this is the way the market moves. So the market the market does not move like this. And on the way up, we can't. So this is why it's so hard for people. Okay. So this is why it's so hard for the people to hold the trades, because, for example, they are entering a trade and now they expect the price to just blast to the upside. It can happen sometimes, but most likely the price will do what we can call a reaccumulation. So on the way up, it will break to the downside sometimes to grab this liquidity, to use it to go even higher. So this is a really common, really natural pattern of the market. And this is a model. Again, this is, so when the market is moving up and then starts this first break or even second break, it's not telling you, and we can say that this is what happened before. It's not telling you here that I want to go down. It tells you that I want to go even higher, but I just need to grab something here. So you will, again, you will see this pattern again and again in the market. We will study it together, but just, so I will just show you one more short note on the Wyckoff. The problem with the Wyckoff, with some people, is that they are looking at this market and they start like to mark up this huge part of price action. They say that this is my like AR, this is my UTED or whatsoever, this is my sign of weakness and so on. And they think that this is the only Wyckoff that is happening. But the problem is the market itself is full of accumulations, distributions, and so on. So for example, here we will have a local accumulation. Here we will have a reaccumulation. So this all is accumulation in itself or reaccumulation from the move. And yes, this is Wyckoff as well. This can be a redistribution. So distribution. So the market can just do this up move and then just start a markdown. But again, in every high, in every move, and in every impulse, you will have a lot of independent accumulations, distribution, and so on and so on. And by the way, when we are looking at our confirmations on lower timeframes, so imagine how this looks on lower timeframes. The market is starting its move. It is looking like this. So you see when it performs a pullback, this all can be treated as accumulation, for example, to go higher. So we just simplify it and say, okay, after the accumulation is over, we want to see our confirmation. So we are entering in the later stages of accumulation. And so we just don't need even to know and to mark this all up. So this is a part of our strategy, but and again, let's just quickly look at the price when it's trending and how it moves. So again, it starts some move, it holds the structure, and then it breaks to the upside, to the downside. Again, this is just a usual reaccumulation. It goes up, holds the zone, starts a move up. So these are local reaccumulations. Again, holds the structure. And by the way, this is why This is why we can trade when we have two shifts to the upside, for example. We can still trade this zone. This zone is even better. So this one is failing, but this one is even better because this is a model of reaccumulation or redistribution if we are talking about bearishness. So this is why they are so powerful, because they are just a part of the market. And again, the market starts to move up, makes these grabs, again moving up. So so this market is just really bullish. At last started some reaccumulations here, but still holding like pushes from the higher time frames. And yeah, so these are nice examples of reaccumulations and so on. So just breaking a bit to the downside, only to continue up. Again, break to the downside, continues up. So you see, any trend will be full of reaccumulations. And when you are analyzing the market, you need to try to find them in the market. And again, Euro USD is a great example.
You mean I would want to find the places where it seems like prices going down, but this is basically just reaccumulating.
Yeah, kind of. So for example, if you were analyzing the market again at this place, you can make a relation between the multi-time frame. So for example, this impulse is an impulse on 3 days. But so this is an impulse on 2 days, on 3 days, and a zone. And then you have a structural shifts. So these are structural shifts to the downside on the Euro USD. But again, what does it look like? Yes, it can be a bearish sign, and yes, the Euro USD could start a real down move from here. But the problem is it's not with the overall context. And again, why? Because we are coming here from the bullishness, and if the Euro USD could break this low, yes, it would be a much more bearish sign. Oh, I didn't delete. Okay. Sorry, I just thought I deleted my trades, which I don't want to do. Yeah, because I journal in the end of the week. So again, when you're looking at something like this, you need to understand this is more likely a reaccumulation. Yeah, because many people will start to sell here. Why? Because they see these shifts of structure. But that's not enough. I mean, it can be enough for some reaction and even for some trades. But if you will make it like the main part of your entry, that if you have just a shift and this is bearish no matter what, if this will be your main part of your strategy, you will not be good, basically, because you will be missing a lot of what is really happening in the market. Okay, so again, we can't just spend all the session talking about reaccumulations, and that's why I will show you much more examples when I will send you homework. Okay, but on the session, I want to make this introduction to the concepts and just emphasize that you will need to see them and to use them. And now next one, overextension, but based on structure. Okay, based on structure. So this is something already that we discussed a bit. So when you have 5 or more consecutive shifts, again, the number is just approximate. It can be different for different markets. Of course, the market can do 10 and 12 consecutive shifts or based on structure. So we are just using the pullback rule. Yes, the market can do this. But if you see a market like this, every time the market will do a new break, you now understand what the market can and wants to do. So in this situation, what the market wants to do here after all these shifts, how do you think?
I think it wants to reaccumulate. It means it wants to go down a bit to
Yeah, at least. So
to break this one to go up then.
Yeah, definitely. So when you have a market that showed you like 10, 12 consecutive shifts of structures, even like starting from 5, you already expecting reaccumulations. So at least one break to the downside structurally on whatever time frame you are.
Does this mean that if we have a market that has that much consecutive breaks of structure to the upside, this is somehow even something like unbalanced? So at some point in time, the market wants to do this grabs.
Yeah, definitely, because this is how the market stays efficient. This is what means. This is what means efficient markets, because they want to do it all the time, and this is why it's so hard. Actually, yeah, this is why trading is so hard, because the market is full of these movements. You will see them every time on every time frame, fractally, like structurally, how you want. It will happen all the time. And then of course the other question is if you want to trade this break to the downside, because I mean, for me, mostly I will not want to trade it, because to trade with some kind of a trend is better, because the price can have higher targets, because we know if this is a bullish market, it can go much higher, and the downside is somewhat limited. And usually the pullbacks are full of more, so they have more redistributions, for example. So the more chances that you will be stopped out at break even, or just stopped out with a full stop loss. So the impulsive side is easier to trade and faster to reach the target. And that's why I told you during backtesting, when you are trying to enter, so let's say this is your zone, and you are now looking to enter, you have some kind of a break. Sorry for my dog today, he is like a bit crazy. So you have some kind of a break, you wanted to enter, but now you missed. And that's why I told you, like, now it's better not to enter here. Now it's better to wait for this and then enter with a new build-ups or something like that. That's why, of course, these first shifts are better for entries, or the best places for entries, of course, are like first shift, second shift, maybe even third, and then reaccumulation, and then you enter here. So this is even more powerful, because you have some first bullishness, you have reaccumulation, and you are good to go. Of course, it will not work like every time, because the market can just continue to accumulate. It can do it. But if you combine everything together, you will find good places and good setups with high probability. Now, next one, space to move in main ranges and the size of a zone. So what it means is, this is a really simple rule. This means that there is a difference if you enter, for instance, so let's make it a bit more simpler. So if you are working with this range, with this kind of range, there is a difference if you will enter here or like here. So again, the market is bullish at this place and the market is bullish at this place. But now you have what you have this, basically you have like 30 points for to protected low, let's say, and then 70 points to a target, let's say like this, simple. But here you have like 70 points to protected low or something like that, and 30 points to your overall target. So what I mean by that, if you have a big free space to move in the main range, it's better actually to enter, because you know you have a space to move, you will have a possibility to re-enter or something like that. And if you are wrong, you will be wrong maybe once or twice. But now here, yes, it's possible to trade on lower time frames, but like the context is not as good as this one. Again, it's possible. It's possible because if I'm trading this range, so if this is my high time frame, I will try to be bullish here. I will try to confirm bullishness here and to make my to have my trades, and even here. So if I will check it right now, I will just maybe even act from inside structure from here again. Maybe price will go here, and it's an okay place to confirm, because we understand that the market probably what it will do now during this week is just go a bit down and either go for this like higher time frames high from here, or maybe do one more move to this 4 hours big sorry, it's like 6 hours, something like that, big range. So but we understand that this zone is possible, and then this zone after the liquidation of everything here is also a good place to long. Yeah, but of course I understand that there was a lot of possibilities, like here, and so on. Yeah. So pay attention how much space you have to move in your main ranges, and the size of the zone is just the fact that you need to keep in mind how big is your zone. So if you have a big zone, so this one is mitigated, so let's say like this, and you are trying now to confirm here, you understand you have like a big space to move now. Yeah, and you can have losers here, you can have losers here, and that's why you need to decide. Either you like have one confirmation, one chance to enter here, and then you stop, because you understand if the market is not running from here, then most likely it will grab even lower, and that's why we're using refinements. Yeah, the simplest one is just to take smaller portions, unmitigated portions of a zone, or go to lower time frames and try to find some refinements there, for example. Yeah, so just keep in mind, if you are tapping into a big zone, then just be prepared and be ready to either take more losers, or just work with this zone, refine it, and trade it smaller. Next one is when you are looking at multi-time frame, at everything, even on your entry time frames, you need to find something that we can call supply and demand chains, or clusters, but chains are a good name as well. So what does it mean? Market can basically do this. It can move like this, like this, maybe even like this, and then like this. So what the market is doing here is creating a chain. Is creating a chain of demand in this case. Why? Because here it created a break and then a tap into the zone, and then here it created a break and tapped into this bigger zone. So again, there are different kind of chains. This one is like combines the root of the move and like just big zones as they are. And again, it created this chain with tapped with this, created a new break, and now it created a chain from the it created a chain from this one, and even from this root of the move. So if we imagine that this is the root of the move, it created this chain. So when you can spot places, again, it's all fractal. So you can use it on your confirmation, you can use it on your middle time frames, and so on. So when you can spot something like this, when you can read chains, you understand that the market is mitigating most likely everything it wants to, and with a chain it has higher probabilities. So when you can spot some kind of a chain, and most perfect ones will mitigate to the most deeper parts. So for example, a perfect chain would be like this: a mitigation of a zone, then a break, then a mitigation of this zone, and then a break, mitigation of this zone. So a perfect chain of supply and demand will be like consecutive and with full mitigation. Unfortunately, the market does not move like this. If it would, it will be much, much easier. So
yeah,
sometimes the market will do this. Up, up. So you see at this place, the chain is broken. And now when you are trading this zone, yes, so this is what I was talking about in the beginning. Yes, you can tell me like, okay, this is my analysis. This is a bullish range. It came from a bullish market, so I'm really, really bullish here. And yes, you are kind of correct. But now you can't ignore the fact that there is a void just underneath this zone. And there was no build up. There was no build up. So now you need to check your higher timeframes, for example. And most likely on higher timeframes, it will look like a really high quality break with a really clear zone. So now you need to decide if you want to trade this. Yes, it can work, but also you need to be extra careful then because your chain is broken. You the market is not supporting itself at these places. So if we see like a real market example, we can spot a chain. We basically see a chain here. Yeah, so I will not be tying myself too much to this time frame specifically because we can view the market across different time frames. But what we see here is a break and a mitigation. We see a break and we don't see a mitigation here, but we see a mitigation of this bigger zone. Yeah, so this is a chain that I showed from here. Then we see some mitigations from inside zones, and again breaks and mitigation. So this is how more or less good chain looks like. And now when the market is here, we can say this: okay, we have a lot of shifts of structures, and now we are coming to mitigate either this inside structure, so already did it, and maybe we'll do once again now from from these down moves, and then this big move is actually supported by everything here, by this chain. It's supported. So these are high probability zones for our trades, this one and this one, because this is coming after this mitigation, and again this is coming from here, from here, from here, and so this move is kind of supported by everything here. And if the market wants to continue bullish, it most likely will do it from these two zones, and then on the other side, if the market will break this, then most likely everything here will be a target, basically, because we understand that the moves that were coming from these zones, from this chain, they already happened. So the market already did what it wants to do from these zones, most likely. Yes, maybe they are part, maybe something here is a part of a higher time frame, but basically it's already happened. They were mitigated, they showed a reaction, and now we want more reaction to the upside. Yeah, so this is something that you need to understand about chains. And again, don't forget, everything we are talking here, everything is fractal. So the same way you are looking at confirmations, you need to understand how the structure is building up itself, and that's why when you have a confirmation, again the same kind, you better not enter here, but you wait for this deeper now mitigation and enter here with your confirmation time frame, because you understand that the chain is not there. Okay, so this is an intro to supply and demand chains.
Okay. Yeah.
Now next question. Try to understand. Basically, it's you don't need to try it because it's easy. Just tell yourself where you are. Are you where you are? If you are now situated after a break, for example. So again, when the market will be here, this is a bit different situation compared to this one. This one bullish, but here you are near the protected low. So you basically in the place where the market wants to go higher, basically. But here you are in the place after you broke some highs after you grab the liquidity. So now you need to kind of expect or give more chances for at least some kind of pullback. I'm not saying that it should be traded, no. But if you want to be long from here, then it makes sense to wait a bit. To wait for, let's say, this or even this. So for instance, why this place is not so good as this one? Yeah, can you tell me why this one is not so good as this one?
Yeah, because we want to see price reaccumulating.
Yeah.
At first.
So of course, this one is based on reaccumulation model. And this one is based just on consecutive shifts. Yes, it can work, but this one is better. Yeah, so when you are thinking about this question, it basically refers to if you made a break right now or if you are like in the zone itself. And of course, how does it relate with the overall bias and so on. Now, next one is easy, not so easy, but again, not so hard as well. This is a question: if you have zones, good zones nearby your zone that you are looking at now, that could be mitigated likely. So this question we discussed already. So let's focus on this one. This is again a popular situation. Schematically, it will look like this. You will have, so let's say you are looking for confirmation or maybe on your middle time frame, and you want to understand if you want to use this zone or this zone. So there can be different situations around this, but if two zones are really close to each other, you just need to pay more attention to what is happening inside the zone, because what it basically means is that we can unite the zone in one. Yeah, I mean, if your zones are really close, then the market can just easily tap into deeper zone, understand?
Yeah.
And then this is just something to consider. This is something that happens often in the market, and then people, they are getting like really confused. Why my zone broke here? I mean, there could be different reasons, because again, this situation is full of other contextual elements, but just based on these ones, you have your zone, and this zone can be even better. It can be a part of a strong structure. It could be much higher in quality compared to this one, and then you can add to this. For example, you have this zone and this one is close, and the price is coming really aggressively into the zone, and it barely gives you just some little confirmation, you know. So the confirmation here can look like this: just real bearish impulse, and then one small like break, and now you are confirming this. So now you want to go bullish. Yes, it can work, but but if you take into consideration that you have like a higher quality, let's say a higher quality zone here, like really nicely looking, then maybe you should wait for more build up. So just don't enter with the first confirmation. Wait for the price to build itself up. So maybe it wants to do this, and then new shifts to the upside. And yeah, just something to keep in mind. And by the way, overall rule is that often it happens so that later confirmations are better compared to early confirmations, because price in the zone, what is happening here? Price is doing an accumulation, of course, because it's just the nature of the market, and accumulation usually happens in a way that it will build some lows, it will liquidate them, and then liquidate once again, maybe even give you this, then liquidate, and then starts a build and so on. Yeah, so this is how the market moves, and if you don't know, you will confirm this, you will have a loser. You will confirm this, and now you will have a loser or a break even because of this. And then on the third time or on the fourth time, already when it all happened, you will have your actual confirmation. And yes, it's still profitable. I sometimes I find myself in this situation. So I'm just looking, the context is good, and I'm just like afraid of losing, missing the move. Yeah. And I just want to enter earlier. But what I recently discovered is that really often later entries will be much more confident, and often they provide better risk to reward, or easier because the structure will be clear. You can have your stop loss like really tight, but here sometimes you will want to use your stop loss below the zone overall, and yeah, so the bigger stop loss RR is harder to reach, so your target RR. Yeah. So this was about, are there any other zones nearby? And if they are, then consider. So you can't ignore. You see what we are discussing today. We are discussing that that yes, you can make your trading simple, and it should be in a way. But at the same time, simple does not mean primitive. Yeah. There is depth. Yeah, there is depth to how the market moves, and all these points. I don't want you to sit with this checklist, and every time you see your confirmation, you are like checking it all point by point. It will not work like this. I want you to build an experience, and based on this, and then you will see it all at the same time. Again, it's all coming back to the language analogy. Yeah, when we are talking, we are not analyzing every word and every sentence. I mean, every like how to say it. I mean, we don't analyze it. We just understand what the other person is saying. But the language is full of rules, it's full of context, it's full of depth, and the same way the market is. But of course, if I want to teach you something like this, I need to start with this breakdown of all these elements. And
but basically that means I will be doing this, but I will be doing it more naturally or unconsciously, because I'm just looking at the market and identify all these things at once.
Kind of. But I would add that you will do it unconsciously and consciously at the same time. Yeah, because you will be able to say what you are looking at. You will not be saying, oh, I'm feeling like the market will be moving up. You will say, I'm bullish because of this and this. But you will do it, you will have a lot of instruments. Yeah, you will have all the sides of the movement that you can include to your arsenal. Yeah. Now, next one. So this one we will skip for now. We will discuss it a bit later. It's not so important. This one is we basically discuss. So what was the previous direction, from bullish to bearish, or from bearish to bearish, for example. So this is basically a question again of reaccumulation and redistribution. We discussed it in the beginning. And how does your middle timeframes look like? We will discuss more in execution, I think, but let me check. Yeah, basically we will discuss it, so I can just delete it. So this was the analysis context. So this is something that when you are coming to the market, again, you will have your first task after this session will be like to take a pair and analyze it deeply. So just try to say everything you can say about the market. And this is a part that you will use, this analysis context. And then there there will be.
You're sending me this as a text.
I will send you this. Yeah.
Okay.
I will send you this, of course, like a checklist for you. And by the way, not every pair will have. So sometimes, for example, there is a point. Yeah. Reaccumulation, redistribution patterns. Sometimes they are just not there, so you just skip it, yeah, or something like that, or overextension is not there. So it does not mean that you need to be like really deep, but it does not mean as well that you can tell me my daily is up, my weekly is down. It's not like that. It will not give you a good understanding.
Yeah.
And then when the market is in your zone, when the market is ready to go, for example, so you have some idea that you now need to confirm, you will have execution context. So this is what happens on middle time frame and on lower time frames. And the first point is, if you confirming straight from the zone or already moving away. So did you do just first shifts, or already you are coming from first reaccumulations and redistribution? So basically, this is not like so strong. So first shifts, they can work, but again, remember, when you have reaccumulation, redistribution, it's much better. This one is, again, it's all coming back to reaccumulations. So for example, let's take this recent example from EURUSD. Again, you have daily zone, you have a mitigation. Now you would like to confirm, let's say on 15 minutes. Let's say you have only 2 layers. You are trading 15 minutes and like daily. So maybe this one is not so good, but because it's like really rangy and messy, but there is a difference between confirming here. So we are just tapped into the zone and barely started some kind of move into our direction. And then there is difference confirming bullishness here, for instance, because here and especially this place is really nice. We already moved some distance from a zone. So this is why you don't want to afraid to kind of miss a trade. I mean, you want to do it, of course, because if you will be totally relaxed, you will not catch any move. Yeah. But then you need to remember, you need to remember that the market will not move like this from a zone. It will do. So this is a bad example, to be honest, because this box is not good, but it's still tradable. But it's just a bit messy. But again, so this is a point. Yes, you can confirm straight from the zone, but it's even better to confirm a bit later when the market already started to move.
Yeah.
Now, how the price reaches the zone, how fast it does it, and this is an interesting part. So if it has a snapback, so let me show you a quick example. And I think I will show you more examples in the weekly recaps. They are not actually happening too often, but sometimes. Again, I'm not showing this trade like to be cool or something, because when I will send you my weekly recaps, you will see a lot of losers, a lot of break evens. It just happens that this trade is a good example. So what we had here is a tap into 5-minute zone, and then a price started to move down on 1 minute, and then on the live price. So I had my alert here at this zone, and the price not just reached to it and fell straight from it. So it was like a really fast snap back to the bearish side. And when I see something like this happens, it means that the price mitigated something big, because if the price is moving quickly, so sometimes it means that the market is just not liquid and the price is just moving in gaps. But this was a high liquidity session, and it was not the case. So, and the price just did this move like really, really quickly.
Oh, yeah.
So for me, this was a good indication that this zone, so this was a good reaction from a zone. And now compare this to, let's say, imagine that the market just like stopped for a bit here and maybe even made a bigger push to the upper boundaries of my zone.
Yeah.
So at this point, my confirmation will not be so confident. So, but my main point, if you see a price during your confirmation, just tap in and then snap back immediately. It's like a good sign. It's a good sign, and combine this with this liquidation. So yeah, it's a good sign.
So that means you went short after this candle? Oh, okay.
Yeah, after this candle, I shorted either on it or on the break of this one. So this was my zone, and this trade will be break down in the weekly recaps. But yeah, and my other point is how the price is approaching your zone and how it enters your zone. So sometimes the price just flies into a zone like this with one candle.
Yeah.
And now you're sitting here, so this is your zone, and you have a huge candle that is coming into a zone. So tell me what the market is trying to tell you at this. I mean, and there is just
you mean also it closes inside the zone?
Yeah, it like closes inside the zone, so this is specifically I'm telling about 1 minute. So imagine I want just to immediately confirm this zone from 5 minutes on 1 minute without this build up of structure, at least of some kind. And if the price is just coming in fast, impulsively, and just breaks almost to the top side without snapping back, without giving me even inside structure, then what is the point? So sometimes people will just enter here. They will say, okay, I can be wrong only once. My protected point is here. I want to try to do it. But what is the point? I mean, right now at this specific moment, the price is really, really bullish. That is why, for example, I'm not entering here, I waited for at least some kind of structure to build up.
Makes absolutely sense. And when price comes into the zone and closes into the zone, I would also assume that it might even break the zone.
I mean, in this case, the price closed in the zone as well, but this is why we are using confirmation. The price then started to go down. And so at this point, it's much more bearish compared to this point. And again, it's all fractal. This chart could be easily a daily chart, and this could be our daily expectations. And so again, so I mean, there is no point to ignore how the market moves in the moment. And this is, by the way, this is a difference between backtesting and live trading. Because when you are trading live, maybe it's more about lower time frames, I think. But even on time frames like 15 minutes, 1 hour, you can still see how fast the price goes into a zone and what it does inside your zone. So it's a good point to remember. Now, next one, of course, is very easy. It's just when you execute, make sure you are doing it during optimal time. So for example, right now, it does not make sense to trade like Euro USD. So it can, depending on your RR, but for me, it does not make sense because I'm using like 5R, 7R targets. And I know that I want to enter maybe during London or in the beginning of the New York. So I have the time to reach my target ideally in 1 day.
Within this session.
Within the session. And of course you can trade for example JPY pairs during Asia. They move nicely. but just make sure to understand what is the optimal session for your instrument. It's really, really important. And not only session, but also specific times of the session. So for example, when Sydney closes, so let me go to baby pips, maybe. Baby pips. So what I noticed, for instance, for EURUSD during previous months, for example, during last hour of during 2 last hours of Sydney, it gives a good foundation for the next move during London and Tokyo. And actually, during these 2 hours, there was some really, really nice moves on Sydney. Then there can be some nice moves on these hours like this. Usually during this lunchtime there is no much movement, and then like really often you can see a good move here.
Yeah.
So you are not only trading a session, but you also want to study your chart, your pair, and understand when biggest and like nicest moves are happening. And then at this time, so we are here. For me, it does not make sense to take any trade. Now, next one is a bit like discretionary. I mean, was there too much movement during this specific day? So the rhythm of the market. Again, sometimes, so let's see what we have on EURUSD now. So, I mean, it still looks okay. Yeah, it still looks like it didn't make too much movement. But imagine that this move happened not to here, but to here. So we are here, and so from the beginning of the day, we made summation range. We made a move up, one more move up, even broke maybe some daily or something. I don't know what is it here. Then made a huge move down. So already during the day we went a lot of distance. And when you came here during this day, if you are trading like relatively low time frames, you need to ask yourself, how much can I squeeze out of this market? I kind of already missed a move up. I already missed a move down. So what can I expect? Basically, you can't expect anything. You can expect only.
Yeah.
So just a point to include to your execution. It relates to the topic of forcing trades, because if you are seeing this zone and now you want to take it higher today before the rollover, then what you are doing? I mean, it's not optimal. And then you are like surprised that the price takes you out and then gives you good setups next day. But this is why you need to wait. Okay, one second. Okay, let's move forward. Okay, chain of S&Ds, build-ups, and waves. So this is the same that we discussed in the beginning. So sometimes you're just looking at your entry time frame, and the market is moving. This is something that you can remember from a topic of quality of structure. And remember that we really like wave-like movements that are not too big. So this can be somewhat good representation, I think. Sorry. No, let me find something different. Yeah, this one could be better. So imagine that you are looking to confirm from this zone. So this is some kind of a zone from high time frames, and now you see how the price builds itself down. For example, it starts this wave. So I call it just wave-like movement. So it does not have big moves like this, but usually what will be the result after these build ups or build downs is an impulse. So this impulse could continue, But when you can spot these waves, these calm waves of price action, something like this or something like this,
Yeah.
you basically want to enter in these places. And then then when you see like bigger expansions of price, it's harder to enter because now you have a lot of space to move down, and usually they tend to liquidate themselves. To be honest, I don't know all the reasoning behind it, but it's just
that's how it happens.
It just happens. And I think why it happens, because when you have an expansion of price, now for the price to reach, and if it reaches the lower point, it will now build inside structure, a lot of inside structure, and maybe it will have more chances to break. If you will confirm straight, it will be harder to confirm. So it's just like in the nature. Now, of course, news. I think you already know, but if you have read news, you don't need to know anything about actual news, but you just need to know about the fact that they are happening and about the fact that they will cause volatility in the market. What the news usually do really, really often is that, so I bet, I didn't research it, but I saw it many times during live price. So you have a bullish structure and overall bullish bias. So when the news will come, will release, on lower time frames, it will do this. The market will go up, for example, and then the news come and they do this during first time. So this is a really bullish sign. This is a really bullish sign if you are in a bullish context overall, because it means that the news release was used just as a manipulation for the price to continue up. It happens like really often. It's much better to trade after the news release, but what I can add here is usually when you have this impulse down, the price will start to build up again, and usually this first low gets liquidated again, and then the price starts to build itself up.
It also depends on the news. I saw news where you have that big movement that happened within seconds. You had no chance to get in.
Yes, usually people people they are thinking that they are missing the move. So this is a candle before the news, and the candle after the news will look like this. So, but there will be no chance. The price just goes from here with a gap. It's just the MT4 and TradingView that draws us this candle. But the move happened like a gap, and there was no chance. But by the way, I think you know the spread usually widens. So if you will try to enter during the news, you will have like really bad feel and really bad pricing. And once again, news does not actually break or cause a trend change. So if you have a bullish bias, the move to the downside will not be caused by the news. The move to the downside will be caused by this distribution, more distribution, and then you will have your trend change. But the news will not play any kind of role. I mean, it plays the fundamentals, of course, play out, but they are basically used by the strong side, by the composite man, by the smart money themselves. But we don't need to know it because we are not moving the market. We are just following what the market is telling us. Again, this is something that people, I think, underestimate. They think that they need to predict to bigger extent that they actually need. What we need to do is read the market, understand what it currently does. So when I'm looking at this bullish market, I mean, there is no way I can tell you that it will do this. But what I can tell you that right now, at this specific moment, it actually does it. So it actually is going bullish right now. And that's why this is my reason to follow it. But I don't know if it will happen, you see? I'm just in this specific moment. telling what the market is doing and trying to understand what it did before and why is this happening. So it's not happening just because of this. It's happening because of everything that happened before. It's a big topic to understand and a really nice help in the analysis overall. Now let's
fundamentals. You said, is this the same as news, or
no. What I mean by fundamentals is this. People think. So again, when I tell people, I'm not like trying to be like above everyone or something. I'm just telling about like beginners. Okay, so beginners, they can think that news are influencing market here, for example, at the time of release. But the thing is, smart money and composite man knew about this news here. So this news, they started. So fundamentals, they influence market here, and news, they influence market short term in the moment of the release. So you see the difference. The fundamentals basically move the markets, but we don't need to know them because we just follow what happens. So we follow already what happened. We are not smart money. We are not the strong side of the market. The strong side of the market defines where the move will happen and like ignites the move and so on. But we are just following. So for me, fundamentals, they are like moving the market, but we don't need to know them. And yeah, that's basically the difference. Of course, fundamentals will influence everything. But it's just strange how people think that they can understand what will happen based on fundamentals. They think that they read some article or have some data points. It's not possible to predict it this way because fundamentals are a pool of hundreds and thousands of factors. It's not possible to analyze it. Like institutions, they have like hundreds of people that are analyzing fundamentals, and they have so much data that it's not even reachable for any retail trader like we are. Okay, yeah, so basically we just don't need to know them. Now this one is also really important. Out of different scenarios, which one has the most support on middle and lower time frames, and or in other words, supportive stories of middle and lower time frames? So what it means? Basically, the market can undergo a lot of scenarios. Again, the most basic one is this one. So just a market, so this is what we trade, yeah? But it can happen in a lot of ways. The next situation can be this, and the trade, so reaccumulation situation. The next one could be something like messy, something rangy, something not tradable on this specific time frame. For example, at this point, you need to go to lower time frames and try to understand what is happening there. I mean, the market can just break and never come back to the zone. The market can, I mean, the ways the market can present the price is really, really big. And we don't need to predict them. We don't need to know actually what will happen long term. Yeah, we don't need to know what will happen like really long term in relation to the time frames you are using. Because when you are looking at the market, try to formulate different scenarios of what the market will do. Yeah, so up, sideways, down, or down, then up, or up, down, and up. Again, at this point, we are going too far. Because what we need to do is just understand the probable scenarios like this, and then ask ourselves, on my middle time frames, on my entry time frame, what is actually happening right now? So for example, I'm coming back a bit to what I told in the beginning. If I'm thinking, if my working idea is that this market is bearish, Is there any sense to short here? For some people, yes, because this move is already some move from lower time frames, and it's a fractal bearish structure already. But for me, if I'm looking at 1 hour, my 1 hour is very, very bullish right now at this specific moment. So my supportive story is this bullish move on 1 hour, and this is what is happening. So this is not something that I'm trying to force. This is not something that I'm coming from my imagination. By the way, what can be an example of something that is coming from my imagination? The example could be like this. I'm looking at this market and I'm telling that I have my higher time frame unmitigated zone. And now I will short this market as crazy, because I think that the market should go here. But this is not what is happening. You see the difference?
Yeah.
This idea that the market can go to this zone to mitigate it will start to develop with this break, at least. Mm-hmm. Yes, for some people, again, if we go to 5 minutes, yes, we already having these breaks. We're already having some bearishness, but at this specific moment, is this like really, really bearish? So based on really, what you see, yeah, not really. Technically, we have these breaks, but basically it's just a reaccumulation pattern. Yes, by the way, I think that this market with the more probability will go to the downside, and then in the end of the week it will clean these highs. But even imagine if you want to go short from here and you think that this is a distribution. So this is something that will cause the market to go down. So this is not enough. Right now, this is just a reaccumulation. For distribution, you want more shifts to the upside and then to the downside. Even something like this, and then like this. And then maybe here, it will have more sense to enter shorts, for example, if you want to force them. Yeah, but the point is, pay attention to what is happening right now with your confirmation as well. So this is a reason why traders can catch themselves in trades like this.
But basically, I mean, we have this consolidation here, and we have this move to here. We didn't. The only thing that we did not have was this good move to the downside to confirm this.
Yeah. So if you are thinking that this is a distribution, yeah, it can be. Yeah, it can be a distribution, but usually, again, I will show you what better distributions look like. Again, coming back to this trade on CHF-JPY. So this is what we now have on Euro USD. Agree? This part. This is what we have.
Yeah.
So this is what I said about distribution. You see, we had more shifts to the downside, again to the upside, again to the downside, again to the upside, again to the downside, again to the upside, and then to the downside. So this is more likely a distribution. But again, you need to combine this with overall context. So the context for this trade was like much different than what we have basically in USD now. But yeah, my point is, for distributions, you need to have multiple shifts, like to one side, to the other side, and so on. Yes, it can be. It can be, by the way, it can go down straight. And if you want, you can confirm it. And it can work out, but just pay attention to the context. And now what I wanted to tell is this one. Yeah, pay attention to what is actually happening. Yeah, so imagine that this is our like middle time frame. Yeah, so this is a zone that we want to have a confirmation from 1 minute. Yeah, and then you go to 1 minute, and price just comes into a zone. So it goes, it shows some up movements, and if you are someone that is forcing the trade, you will trade here, or maybe even here, like this. You will be liquidated. Then you will refuse to invalidate your idea, you will trade here. But again, just ask yourself, what is happening here? What is happening here? So at this point, we already broke our protected low. At this point, nothing is happening in our side. So nothing is confirming our idea that the market wants to go up, for example. And then you need to ask yourself what you want to see. And you want to see this, you want to see this, or reaccumulation, and then enter later. But this is why we're using confirmations. This is why we're using context. And the last point for execution, at last, invalidation should be invalidation and not the reason to look for trades in other direction. So this is really important. Unfortunately, sometimes, or maybe even often, I don't know, our ideas will fail. So again, this is a 5-minute zone, and let's pretend that we have an idea to go to the upside from here. And we can have our loser. Yeah, so we put a trade, let's say something like this, and it's a loser. So this is a point of invalidation.
Yeah,
it can play an evil game with you, because if you invalidated your zone, and if your mindset like is more like a beginner's mindset, now you can start thinking that, oh my god, I missed all this move, because now you're looking back and you see, oh, maybe if I was short here, I would catch this wave. And then you can start building many reasons why the zone was bad, actually. And then, yeah, then you can start to try to catch this move. And instead of really invalidating your idea, and so stepping back for some time to see what the market wants to do now, you start to short, for example. So you want to have this trade. So now you just switched your bias, you are shorted. So you got liquidated here, but now you see, oh, maybe the price is just grabbing the zone, and now you want to have this long. So, and you are just starting this back and forth. And again, it all happened because your invalidation point didn't play out like invalidation point, but because it happened for the change of your bias just to every side. So yeah, invalidation should be invalidation. Sometimes the market does not confirm our idea. It does not make sense to like really fixate on one idea. And yeah, sometimes the market just needs the time to decide and to show us what it needs to do. Okay. I need water. So this is how the context can look like. I will send you examples of outlooks. You will study a bit more, and let me check.
That's good.
Yeah. Good. Now let me check what I have here. Yeah, so for the structure, we discussed clusters. This one discussed. Okay. So one more addition to the structure is the usage of inside structure. So what are sometimes what are possible situations where you can use inside structure while you are entering? So imagine that again you have a zone and you have a tap. You have a tap on your entry time frame like this.
Yeah.
And then the price starts a build up of really clear structure. But the problem is the inside structure of this range. So basically, technically, if you are like really trading what we discussed in the first session, you need to wait for a break of this. So when you have an overextended range followed by a clear build-up of inside structure, of course, with the overall supportive bias from other timeframes, from everything you now know and will start to practice, so there is no reason you can't use inside structure on your entry timeframes, because inside structure is basically the same structure but just fractal. Yeah, because we again, there is no sense in ignoring it, but just make sure that your inside structure is like corresponds to the rules that we have for the quality. So let me quickly so for example, inside structure can have its own rules for the pullback, its own rules for, so I had an entry from inside structure for Euro USD, maybe, but it was from previous week. I will not find it. Let me quickly. Yeah, so something like this. Again, this is just an illustration, but obviously the price just tapped into something here, probably with the news, and now you have this overextension. Let's suppose you have a bullish bias. So what is happening here? We have a wave-like motion, pretty clear breaks, and you see inside we have all the pullback rules, all the breaks. It's just the problem is that it's happening inside this expansion of price. And again, if you have a build-up, you have a chain, you have a context, then why not use it? So these entries like this are possible, and they are basically okay. So this is one addition about the structure. Now, what I wanted to add about the refinements. When you are looking at refining a zone, so let's look at this one. Maybe let's look at this one. So this is a zone from 3 days. And for example, you want to go and refine it to on lower time frames. So make it smaller. And let's go to 1 hour possibly. Yeah. And when you are looking at the zones on your lower time frames inside your higher time frame zones, try to find again high quality zones based on usual rules. And specifically, I'm also telling about the zones that did something on this time frame. Basically, zones that had some breaks afterwards. So, for example, compare this zone and this down move, for instance. So we clearly see that this break happened from here, and this one caused this small move. Yes, it has some breaks, but like the main break and the main volume, it seems like came from this candle. So this was the main candle inside this daily zone. So this refinement could make more sense. Yeah, so something like this. When you are looking for refinements, try to pick high quality zones and zones that actually participated in the breaks of structure on these refinement timeframes. Okay, and the last one, for your quality of trades, but again, it's more, you will find more relation to it when you will start demo trading, when you will start live trading. But right now we can start discussing. Yes, we have quality of structure. Yes, we have quality of supply and demand, quality of confirmation, which is basically the same like structural quality. And we have now context. And when you have everything aligned, it can be an A setup, yeah, high quality setup. When everything tells you like about high probabilities of the move in one side. But then what I propose you to add to this quality of trades is mental state as well. So for example, if you are focused during a trade, if you didn't have fights like in real life with anyone, like you are not frustrated, you are basically neutral, you have neutral mindset or just like calm, and relaxed, patient, confident. It's a part of a high quality setup. And if you are entering a technically high quality setup, but as a part of chasing price, or as a part of fading direction moves, or as a part of like not following rules before that, so you are angry, you are fearful. So is this a high quality setup? Technically, yes, but maybe if it will be a loser, it will be like a consequence of this will be you giving up even more emotional capital. Yeah, so that is why when you are thinking about if you're trading really high quality setup, think about your mindset as well. So include this in your mindset. So let me show you quickly on my plan. So what I have here is okay. Yeah, so I have my description of my high quality setups. Like A quality. It starts with technical part, so everything we discuss, like confluence, supply and demand, confirmation, so on. But then I include some intuition, some mindset, and so on. So if my mindset is poor, I cannot say that I'm entering a high quality trade. So something is wrong. Okay, so basically that's it for today.
All right. This was a lot of stuff.
Yeah, it was a lot of stuff. You will come back to it. I will shortly send you homework.
Yeah.
So we will start with the outlooks and then some backtesting. And then so after this session, you basically can start after some backtesting, live demo trading. And yeah, there will be a lot of things to discuss. So of course, it will require some time from you.
Yeah.
What I want to ask you after this session is that please remember, I can't give you feedback if you don't show me your practice, your screenshots or your videos. And by the way, I have another student, Stefan, and sometimes he, like on backtesting, he makes screenshots and he journals, but he also records a screen, a video screen of him backtesting and like talking through what he thinks. So I found it's really nice for me because I really see what you are looking at and I can give like real good feedback. But again, even if you're, and yes, you will be confused, but even with the confusion, you need to do what you can. So you can have like 10 losers, but it's better than you can just then you message me that I'm confused, please explain more. So I will not do it. Okay, I will wait for your work, actual work.
Yeah. Okay.
Then I will explain based on this.
Yeah, I think if I make a video and send you that is probably a good thing for correcting my back testing a bit, so we can get back on track.
Yeah, definitely. We can do like different forms of communication. Let's just quickly try to do the homework. It will be like really limited. It will not be like really hard. And then we will move to third session, and basically after third session, you will be able to start some live trading and so on. Okay. And by the way, how do you think in the coming weeks will you have some like hours, some free hours for trading?
I think so. It will be better now.
Okay. Any last questions for today's session? Any requests? Maybe anything to share? Anything?
No, I think what I have to do is to try a bit more back testing and also send you a video. Maybe I also have forgotten some things from the past sessions and I have to recap of some things. So because I was really a bit bad with my back testing, and I know that I had been doing better before, and
yeah,
I want to come
that's
back
again,
to this.
but even with that, if you take your backtesting journal, you had some profitable trades first of all, and it's really, so to be honest, I was a bit surprised because it's really early to say at least anything. So unless you have at least like 50, 60 trades or maybe 100, you basically can't say anything about the system. So right now you are acting just from my words. But this is what I want you to do, to start building your own experience. And yes, you could have better results or anything, but you just need to work through it. So yeah, I will send you homework. It will start with making an outlook for a pair, and then we will go from there. Then we'll move to backtesting. Okay, team. Okay, have a good evening, and I hope we will work like effectively, and it will all be good. So sending you recording soon, and bye.
Thank you very much, and see you soon.
Bye. See you.